Well, hi traders, Chris Weston here, head of research at Pepperstone. So we're going to go through the gold market. But I'm not just going to take it there. I want to take it into FX markets. I want to have a look at really what's going on in the yen. There's been a few requests to talk a little bit more about what's happening in the yen and the yen crosses as well. And also take a look at treasuries, and the yield curve has definitely been coming onto people's radars. The inversion that we've seen in 2s, 10s, and when ultimately, what's that mean? Should we position ourselves more defensively because of this reliable indicator that 2s, 10s inversion has given us over the last 3 or 4 decades in terms of potential impending recessions coming through? So that's definitely something that we've focused on. We'll sort of feed it back into the geopolitical situation and ultimately how people are taking on risk and equities as well. So let's have a look at the gold market over the last 5 days. And what we've seen in dollar terms has been that the gold market is down, 12 basis points. So it's pretty flat. It's pretty much unchanged. We're seeing a bit more weakness playing through in the palladium market. You can see there's been a bit of vol coming through in that space. You should imagine the liquidity is obviously not as prevalent in palladium as what you're seeing in silver and gold coming forward. So a bit of a mixed picture coming through there. But I think if we take this to G10 and see how we could have traded gold and some of these metals in foreign currencies, as you know, I talk about this week in, week out, is the idea that we offer gold in alternative currencies. So if you want to take a long position, you want to try and do it in the weakest currency or the perceived weakest currency. And if you want to take shorts, you want to do it in the strongest currency. So that's where we can get double bubble, or you can just keep it simple and just trade XAU, USD. But what we've seen over the last 5 days since I did the last video is that the Japanese yen is down 1.7%. It's arguably the weakest currency. Now, why is that? There's a number of factors behind it. But first of all, it's just currency trading 101. We go back to our bread and butter, this idea about yield differentials and spread differentials, and this idea about central bank divergence. One central bank is getting more hawkish, as we're seeing in Canada, like we're seeing in New Zealand, like we're seeing in the US, even to an extent Europe. I mean, we're yet to see the RBA really turning, but they are making noises, and the market's certainly speculating that it's a matter of time before the RBA come to the party. But certainly the Bank of Japan, arguably the most dovish there. Kuroda has been working at the head of Bank of Japan, has open arms on the yen weakness. Now that's starting to change a little bit. But if we go to this chart, I think it's really interesting just to show you how pension funds in Japan are thinking about this move that we're seeing in the Japanese yen. If we go to the top pane, you can see the yellow line is dollar yen, which of course got up into sort of 125s, and then we've had a bit of a reversal. That 125 is really interesting because when we saw intervention coming through over the years, that 125 level has been aligned in the sand, and effectively what you see is the Bank of Japan coming out and saying that they're watching currency markets very closely. Now, the Bank of Japan, I think it's really important to understand, can't or don't intervene in the FX market directly by buying and selling Japanese yen and causing 200, 300 point rips coming through in the market. What they can do is they can change the interest rate policy from negative interest rates, and they can change the yield cap that they have at the moment. The current yield cap is that they're going to have fixed unlimited buying to fix the 10-year JGB, the government bond there, at 25 basis points. So they could effectively bring that down to about, say, the 5-year tenure of the bond curve, and that could have impacts. That could allow the 10-year to freely float and have proper price discovery, and then have a steeper curve. I think if we were to see that, then go out and buy Japanese banks, I think will be an absolutely ripping trade if we see that yield curve feeding through, because Japanese banks love borrowing short term and lending out long term. I think that would be a ripping trade if we were to ever see that. But what we would see is the Ministry of Finance in Japan, who's the government agency, obviously, then looking to infiltrate and intervene on the market. So 125 is your level that we're now seeing currency intervention coming up on their radar. They've talked about it a number of times over the last couple of days. They're watching currency levels. It wouldn't happen until we got above 130 in dollar yen, for me, that they would actually potentially come out and buy yen to try and stabilise it. And really the idea here between currency intervention and jawboning at the moment is to try and ward off shorters, and people saying, you don't really want to be short if we come out and cause a 100, 200 point rip in dollar yen to the downside there. So that's something we are watching very closely. But you can see, let's have a look at what we're seeing. Let's have a look at basic 2-year Treasury yields, where obviously interest rate pricing has become very, very rich indeed. I can have a look at interest rate pricing on this table. Let's go to the swaps market, and you can see what's being priced in. Now, let's have a look at this table over here, and we can see that the implied rate by December is another 217 basis points of hikes just this year. That equates, if you divide that by 25 basis points, to 8.6 hikes. The interesting thing is, for the next meeting that we've got on the 5th of May, for us in Australia, in the US it's the 4th of May, there's now a 76% chance of a 50 basis point hike. Citigroup obviously causing a bit of a stir last week on the idea now that they believe personally, and I think it's a bit punchy myself, that you're going to see 4 back-to-back hikes consecutively from the Federal Reserve. But if you look at what the market's pricing in, it's not what I expect. This is what the market's saying, that they expect to see 219 basis points of hikes by the end of the year, and you can see that's that's basically 8.7 hikes by the end of the year. So you can make your own judgment call on whether you think that's going to be the case. But what you've seen in dollar yen and the yen crosses effectively is been the yield differential in short-term rates has moved up substantially against Japanese. And again, it's that currency 101. So 238 is the nominal 2-year advantage there. You can see on a hedged basis, and if I'm a Japanese pension fund, for example, and I'm going out and I want to deploy and look for yield and look for interest and look for income, or what we call carry. If I look at the 10-year US Treasury and I put a 3-month hedging ratio on a hedging cost for that, I'm going to get a 1.36% return. So that's yen hedged effectively. So a 10-year Treasury adjusted for hedging costs into Japanese yen. That's pretty compelling. Now, if you look at the bottom pane, you can adjust that again for what the yield that you can get in JGBs. And if I'm a pension fund in Japan and I'm running massive trillions of billions and billions of dollars, I'm looking at the yield advantage that I can get on a hedged basis in the US, and I can see that's 111 basis points. So why is dollar yen, why is Aussie yen, Noki yen, all of these currencies been doing what they've been doing? Well, it's just a central bank divergent trade. As we can see, short-term rates have been pricing in more, and people are front-running the idea about where capital is flowing. And the question is has this got more juice? Now, if I have a look at what we've been seeing in Aussie yen, for example, which is where we've seen quite a lot of business playing through, it's just been a big momentum trade. So we've got that yield advantage, with what's being priced into Aussie rates over 12 months, and that's pushed short-term rates on a hedge basis higher and higher and higher. But what we can see is that this has just been a beautiful momentum trade. Now, if you're running a systematic or a rules-based strategy, you're still probably in the trade. I'm looking at this as a 3-day exponential moving average relative to the 9-day exponential moving average. You can take it shorter into something like a 7-day if you want to have a much shorter time frame, and we can do that certainly at the moment. Let's take this down into a 7-day. But you can see we're still very much in the trade. So we had this sort of recall on Aussie yen. We pushed higher. It's now consolidating. A few sellers into the mix above 94. And now we're just looking to consolidate. And again, that comes in line with what we've been seeing from the Bank of Japan, who are now saying that they're watching markets. It's just warding a few short sellers off in terms of the Japanese yen short sellers. But I've also had a look at some of the metrics that I look at just to see how overextended these markets are. And you can see that we got about 2.4% above the 5-day exponential moving average. The price had just ripped to just become a little bit impulsive. If you look at that difference between the 9 and 3-day exponential moving average, which is an indicator that I've coded here on TradingView, you can see we got up to 209 pips, 209 points effectively, which is one of the highest levels we've seen for a long time. So again, this isn't necessarily a mean reversion tool. It does tell me that things have probably just got a little bit too far, and it does tell me that I don't want to be buying or taking on new positions, and that serves me pretty well. You don't want to be buying when that price is just a little bit too extended. But in terms of that momentum move, we're still very much in the trade at the moment. Okay, so we're going back so we've seen what's happened in the yen. I want to have a look at actually gold in Japanese yen terms, because obviously what we've seen is the yen has been weaker. So if you want to buy gold in the weakest currency, well, it's clearly been the Japanese yen. And so we've got this breakout that came through. We came back, we tested that support. The buyers did a bit of a stop loss run coming through there. The buyers have stepped back in. So it's a difficult one at the moment. We've made this kind of series of lower lows or lower highs. And it really it's given me nothing at the moment. I just want to see a bit of buying coming back in. We'll just have to see what happens with the Japanese yen. Not a trade that I'm necessarily going to touch. Obviously, if we get a close through these lows here, then I think perhaps there's going to be some shorts on the table, and that may well come in a situation if the Japanese yen was to strengthen. But in this interest rate divergence dynamic, it's not necessarily something that I really want to touch at the moment. I think a really interesting trade is the risk that's coming back into the market. Now, of course, there's been some fairly constructive dialogue that we've been seeing recently, and we've seen that in the equity prices. I want to have a look at European equity markets, because that's really where we've seen a lot of the covering of shorts playing through. Let's have a look at the DAX, for example. Let's have a look at our DAX price. Okay, so nice breakout that we've been seeing. Now, obviously, what the dialogue that we're seeing on a geopolitical perspective is fantastic, not just for markets, but also for the human race as well. We are seeing clear signs that Russia and Ukraine are coming together. It's obviously very technical and very emotional at the moment, but we are seeing signs of constructive dialogue. It looks like Russia are pulling out some of their military involvement around Kyiv to improve mutual trust effectively. They've said that they've got past the first point of the special operations and they want to ring fence what's been going on in Donbass. But the market is seeing a bit of togetherness. And as you can see from the DAX or the Germany 40, that clearly this is now broken out. This looks good. Do we start getting a retest back into 14,500? For another leg higher? I suspect that's going to be the case, but we'd also need to remember that we've got quarter end coming up, we've got month end coming up, and we could see some repositionings playing through and what happens on the new quarter. But I think if you're looking at the DAX at the moment, it's probably one of my picks of the markets that I'm seeing. The other one that's been getting quite a bit of attention is really what's happening in the NASDAQ. Let's have a look at it on our charts here. You can see that we've come back up to this point here. So this is about 18% off the lows. So there's a bit of risk coming back into the market. We've seen the VIX and the implied volatility in the S&P coming back below 20%. So people have looked to sell vol in this market. But I think this is one that you probably want to have on your radar as well. I think a break of 15,260 would be pretty convincing and pretty compelling, to be honest. And I think that would be something that would potentially cause another leg up in Aussie yen and some of these markets there. But it does have implications for the gold market as well. If we have a look at the US 500, now we're coming up to a situation where we're going to start getting into confession season. The earnings season is going to be coming through in mid-April. JP Morgan will be going, I think, around the 12th of April. So I think earnings are really interesting as well because earnings have not come down throughout this cycle. Earnings have not been coming down as well. So if you have a look at the S&P, we have broken out now. So again, this looks like one that could be going up back into 4,800 over time as we go into that earnings season going forward. Now, one of the other factors that we've had before I get focused on the gold market is really what's happening in bonds. We looked at the idea about what's happening in the differential between US rates and Japanese rates and how that's affecting the yen on this kind of divergence trade. But the big one, of course, is this idea now that we've seen inversion play through in the curve. Now, we did see inversion play through last night. That means that the 10-year yield on the 10-year Treasury has become lower than what we've been seeing on the 2-year Treasury. And people on Twitter have made this assumption that the world's about to collapse, and we're looking at an impending recession. And there's definitely some validity to that because pretty much every recession that we've seen in the last 30 or 40 years have been preceded by inverted curves. Now, the interesting situation here is that if I look at this piece of, if I look at the statistics around this, it does take quite some time before the first initial inversion to when we see a situation when we actually get into a recession. I look at 2s, 5s, so the difference between 2 and 5-year Treasury yields. As you can see here, this is a point where we got inverting, but so the 5-year Treasury yield trading at a lower yield than the 2s. But you can see really the financial stress, and what really concerns me is not so much the inversion. It takes on average about 19 months from the point of inversion going through to the point where we actually see a recession. But I think the interesting situation where the S&P gets hammered and where we see gold prices being a really good hedge against economic duress is when we see the yield curve start to steepen. So if we look at 2s and 10s, we can see that there's this rampant move back up here. So 10-year yields are moving up much more aggressively than 2 years. Why is that? Because 2-year yields are moving down because people are repricing rate expectations. That's very, very important. This is the time when markets start to panic. Okay, when we start seeing economic fragility playing through, that the Fed have tightened too quickly, they've caused a recession, or it could be emerging markets have been getting hammered, or whatever the situation. But it is not until we see a situation that yield curves start to re-steepen and the market starts pricing out rate hikes and saying that the Fed are going to have to adjust their pricing, that's when the S&P starts getting hit. That's when gold prices start rallying. That's when volatility starts rising. So that's what I'm looking for. If you have a look at 2s and 5s, inversion, aggressive steepening. And what we always find is that with the Fed then pivot and you can see rate cuts into a recession like we're seeing in these red lines there as well. So for me, it's not about the inversion itself. That is a bit of a red flag traditionally, and this time could be different. The dynamics are very different. But what we tend to see is a situation when it's really starting to steepen, when this starts to aggressively steepen, that's the time to start really getting defensive with the market, looking at quality, potentially looking at shorting opportunities far more readily, protecting yourself and your portfolio. And so for me, if we're looking at that, I think we really need to look at the slope. It's when the market starts steepening that you need to start panicking a little bit there as well. Okay, let's have a look at semantics around gold. I'm going to have a look at the options market, and then we'll go into the gold pricing and actually the technicals that we've been seeing there as well. We know that the yen's been probably one of the better places to be long, but if you're looking to go short on gold, the best place to do that is in the Canadian dollar or the Aussie dollar, and even the euro to an extent. I think the euro is a really interesting currency. I'm just going to touch on that because you saw the DAX and just how people are reacting to this idea about better dialogue. Let's have a look at euro dollar because euro dollar for me is we're pushing into the top end of the range now. We've got this lovely little resistance that's taking place. The market just fades it every time into 111.20. Obviously, a break of that situation, we've been making this series of higher lows. Big move up as people de-risked their short euro positions because of these constructive headlines. But 111.20 is the line in the sand that you need to be looking at there. So if you're looking for short positions in gold and we were to see euro dollar break above 111.20, then I think for me, looking to short gold in euro terms would be the trade to look at. But that is a really interesting one. If the DAX breaks out, then I expect to see euro dollar going through. And of course, everyone hates the euro at the moment. We're going to see a potential recession in Europe. No one likes euro, but the price is the final arbiter of all sentiment. And I think a break of 111.20 could be really, really interesting there at the moment. The market's just respecting that. I think for me, we can't get sort of looking at more shorting positions until we get a break, 109.58, those kind of levels down there. And I think we'd probably make new lows in there. So at the moment, we're just trading a bit of a short-term range. I want to see the market break out of that range. And I think that's where we're going to start seeing a new trend developing going forward. Now let's have a look at the gold market. Let's have a look at it in dollar terms there as well. So we got up a little bit of a retracement down into 18.95. We pushed into the 38.2 retracement of that move there. So that's clearly the resistance level that we're looking for. What we're also seeing there, if we look at it on the daily chart, I'm going to take this into a 4-hour chart. It's just look at this support that we've got through below 19, but below 1910 effectively. Market makes a move, 1907 gets down to the figure, gets below the figure. Buyers step in, it starts to move up into 1951. We trade sideways, we push into that 38.2% retracement. We see a fake out, the market trends lower. Again, we get that capitulation move down there. The buyers step in. We're just sort of struggling sideways at the moment. So again, it's a difficult one to trade gold because the price action at the moment is very much sideways. There's really good supply through 1907, and I think that continues to be the case. I'll be looking to buy pullbacks through that level with a stop through 1875. So you're taking about $20 of risk on there, but you can see that there's lots of bids coming back into the market there. It needs to push back into those levels of 1960, and I think a break of there then would take some momentum long positions for a move back here. What we'd also look to do is just put the Bollinger Bands on here. If we get a break through this 20-day moving average, through these highs, I would expect a simple move just back up into the top Bollinger Band, where I'd expect price, therefore, to consolidate through that situation. And again, we'll see what happens there. But again, if we're going to see equities moving higher, if we're going to see rates moving higher, then obviously we're going to see a situation where the gold price might come under pressure. If we're going to see positivity and lower volatility, then I expect the gold market to continue trading a little bit lower at the moment. So it's an interesting setup. I want the market to reveal itself. What I'm seeing better opportunities in at the moment is in some of the European equity markets, what we're seeing in euro. The yen's quite interesting, but for the gold market, for me at the moment, I really need to see the market breaking through 1960. And I really want to see how markets act again if we get a break back into these lows again. Are we going to see those bids coming back into markets again? So an interesting setup. What I will put onto the radar is this Friday we've got the non-farm payrolls number. The market's looking for something like 490,000 jobs. We're looking for that average hourly earnings to be 5.5%. That's probably the big one that you really want to look at. And I think there's a lot to look out for in that ahead of the CPI numbers that come out in April as well. So watch that one. I think that could be an interesting one. I personally see downside risks, which could see dollar yen a little bit lower in the short term as well. So I hope you've enjoyed the video. If you've got any questions around what we're seeing, some of these levels that we're looking at, how we're defining these moves, and obviously some of the other factors that we're looking at, do reach out, leave a comment in the situation, and like the video if you like it. All right, cheers. See you next week.